Last speaker for today, we have Adam Roberts, who's Head of Private Markets at Australian Ethical Investments. Adam joined Australian Ethical in June 2024, bringing 15 years of investing experience across real estate, infrastructure, private equity, impact investing and private credit. Prior to joining Australian Ethical, Adam held several roles within Macquarie Asset Management's business, both APAC and Europe, as well as Head of Strategy, where he oversaw the business and corporate development.
Very good. Maybe two observations before I jump into the presentation. I think it's been at least consistent, the themes across each of the speakers. So at least if they're wrong, we're all wrong together. I've got probably similar type themes to talk about today, so I'll make sure I run through some of them pretty quickly where we've maybe laboured the point. The second point maybe I'll make is maybe it's an apology. Maybe we should have scheduled a coffee break before I jumped in, because infrastructure is inherently boring, and so maybe at this stage of the afternoon I might fall asleep on a couple of people. But
you and the discussion was standing between us and a drink.
Exactly right. So, but I want to highlight the reasons why it's great that infrastructure is boring when you're thinking about it as part of your portfolio. So we'll jump through. Everyone's kind of had a slightly different definition so far today of what a private asset, so I might just frame it in terms of how I think about the world. We've got venture capital on one side of the spectrum through to infrastructure and property on the other side. There's probably two ways to think about it. It's the types of risks that you're taking on and the types of underlying assets or physical assets that sit around your investments. So for me, when people think about venture capital, some people think about sort of throwing money at a wall and hoping something sticks, but it largely sits around you've got a new business model, a new technology, it's unproven or it's slightly proven, and you need to sort of bring it to the market. The next being growth equity is sort of taking something there that has been proven out in some way, but in order to make that business worth more money, you need to sink growth capital into the business. Those businesses are going to be loss-making and need more capital, and you need to hope that at a period in the future somebody values it at more than it is today to be able to find that extra capital. We've talked a lot about private equity, but that's going to be into more stable, traditional businesses, taking them from X to Y and hopefully taking them on a journey when there's sort of a material improvement in terms of the quality, the processes and the earnings that sit around the business. Then we get to the left-hand side when we're talking about infrastructure. So it's an asset that there's physical assets there, there's either long-term cash flows, regulation, moats around the business, because ultimately at the end of the day they're sort of essential services. So whether it's yesterday, today or tomorrow, they're a business that exists in society for a purpose and will continue to be required, good times, bad times. And so this is kind of the point that we sort of everybody's brought up this afternoon as to why, but sort of just really quickly in my words. So we've talked about more diversity. We've had some stats around the number of public companies have roughly halved. When we think about it in the US, the number of private capital-backed assets is up 7 or 8 times over that same period. So there's about 2 to 3 times the number of private equity-backed businesses in the US than there are listed companies. The opportunity point, again, has been talked about here, but as businesses stay private for longer, they've gone from being about 5 years to sort of 10 to 12 years today. You're seeing far more of their growth happen in the private universe, which means that when they do eventually come to the public markets, they're far more steady state, kind of chugging along businesses, and you've missed out on the opportunity to be supporting that business go from X to Y and see a material part of its growth. The focus points, probably the biggest one in my eyes, which comes down to having a targeted group of aligned shareholders. So when you buy into public markets, you own a fraction of a company. It's a residual claim over the business, whatever drops to the bottom line, and the board decides to issue as a dividend, or where the market sees the listed share price move. It's very different in private assets. You own collectively that business with yourself or a few other people, and what you're looking to do with that business is really aggressively drive an outcome. And so what you see in the US is that people have benchmarked the Russell versus private equity indexes, and there's about 1.5% to 2% of extra EBITDA growth that's being squeezed out of private companies, and that's largely because the shareholders are on the board, control management, control a business plan, and drive a business from X to Y. which then links into the more patience piece, which is you're not looking at quarterly reporting cycles, you're not thinking about what you're going to message to the market next time around. You're able to invest and invest for the future and see your investment decisions through. So there's far more CapEx that gets spent in private businesses. So the board and shareholders decide to say, hey, I'm going to invest here. The payoff period might be 1 year, 3 years, 5 years, whatever it is, but we can believe and continue to make that investment rather than be at the whims of the public market, people's sentiment, the mood changes, and people aren't prepared to invest that capital anymore. So we'll come back to infrastructure. So what do we like? We talked about it, physical assets that have an inherent worth, whether it's infrastructure, real assets, real estate, asset-backed private equity, and as I mentioned, sort of essential services that we need in the communities. And so we have sort of inflation linkage, so in periods of high inflation, periods of low inflation, the assets continue to perform. They're unique opportunities. They tend to have sort of a large moat around them because you can't tend to have too many of these businesses competing with each other. Sometimes in regulated businesses by design, you don't have any competition, and therefore that's a great steady cash flow to have. And then we'll come to the next slide as well. We also think about it from a future-focused perspective. So infrastructure is a really great place for you to think about when you're exiting this business, what does the world look like when you are trying to sell? That's how you determine what your asset's ultimately going to be worth. It's not what you paid today, it's what you're able to sell it for in the future. And you're able to really think about, well, where's the world moving to? How are people going to value these types of assets in 5 years or 10 years when you're looking to exit? And so we invest as a house across sort of 5 key thematics. You know, there's a huge need for capital over and above what's forecast on the decarbonisation side. There's a gap of about $3 trillion that's needed. On the circular economy side, there's about 2 million tonnes a year of waste that goes to landfill. 99% of the goods that are produced each year go to landfill within 6 months. So there's a huge need to solve that problem, and we're getting to the stage as a society that there needs to be a solve for it because it can't continue the way it is. So with each of these thematics, there's a tailwind that we think that we're investing into. It should help us, as I said, for our exit. Digitalisation, we've talked a lot about AI, data needs, but also the importance of sort of digitalisation for education and for jobs. So 4 out of 5 jobs now need sort of digital literacy. There's a place for us to play in terms of being able to take businesses from A to B on that front. Urbanisation, changing demographics. So 1 in 10 houses in Australia have 3 or more spare bedrooms. So there's a supply issue from housing. The median family can only afford less than 40% of a family on $200,000 income can only afford sort of 40% of properties that are out there. Somebody on the median income can afford less than 10%. So there's a supply issue there as well. And then changing demographics, over 60s, over 80s, they're going to double and triple over the next few years. So you need purpose-built accommodation and health services in order to sort of satisfy that part of the market. So making long-term investment decisions today, it needs to happen today. There's a capital need, there's a time period, but then you're selling into a market in the future that's going to benefit from these tailwinds. And so I came from an institutional investing background where you'd go to a big pension fund and you'd bang your head against a table and you'd talk to them 100 times in a year and then you'd get a really big allocation out of them. They're happy to go into some very long-term, illiquid type structures where they might want to hold assets forever. They may never want to find liquidity. But when you move into the wholesale world, and we've talked about it today, what are the 3 things that are really important? So liquidity, diversification, and scale. And so when we think about how we take products to the market, we're looking to address those things first and then sort of backfill a product in order to be investable. So from a liquidity perspective, you're looking at sort of at a minimum sort of having quarterly liquidity, monthly applications, quarterly redemptions. From a scale perspective, you want to be able to bring in small licks of capital and not have sort of the large minimums that sort of typical private equity funds would have. On the liquidity point, you know, it's not a 10-year closed-end kind of fund where you take money today and someone makes a promise they'll give it back to you in 10 or 12 years' time. And all of our products are open-ended and evergreen. So the idea is that you have one capital call today. You don't need to worry about, you know, that drawdown effect over time. Then from a diversification perspective, so We're both a fund manager and a super fund, and so have access to a lot of the best partners and the best origination sources, both in Australia and globally, and we look to bring that together to create a thoughtful portfolio that sits across those thematics, across various different partners, and across different time horizons as well. So one of the things that helps with liquidity is making sure that you've got different phased investments, so you've got different money being realised at different points in time through the future. And then I think we've talked a lot about the bottom three today in terms of how you find the right partners, how you diligence the good from the otherwise, how you're able to move quickly. A lot of these co-investment type opportunities, you've got a relatively short period of time, you've got a comprehensive but targeted set of information. You need to be able to work through how you get from A to B, to solve all your legal, your governance, your documentation, etc. And then access as well. Sometimes there's a little bit of self-selection bias, which is the things that you're able to see are the things that nobody else has wanted, because if everybody else had wanted it, there would have been a lot of competitive pressure on getting access to the opportunities. And so we'll jump into unlisted infra. And so we target it in two different ways, on the debt side as well as on the equity side. And we think about debt again, as I said, infrastructure debt in the bottom left-hand corner. It's the most boring of asset classes, but we really like that, right? The reason being the types of characteristics for infrastructure loans. They're projects that have long-term contracts, so somebody's agreed to buy the electricity or the energy that comes out of a renewables project for 10 plus years. Your loan is only for 3, 5, 7 years, so you've always got coverage on the revenue side on your business. The projects themselves, you're not buying land like you might be in real estate credit on the hope that you get your approvals and the building gets completed on time and on budget and somebody buys it at the end. Lots of the time your capital is flushed through as a result of the revenue that comes out of these businesses. The build cost is a far more larger component on these projects, and they're typically wrapped as well, which means that somebody has decided to guarantee delivery of these projects, and the amount of leverage in these assets tends to be smaller than in real estate credit. On a total development cost basis, it's sort of 40 to 60% as opposed to sometimes 80 to 85% of cost being provided by the lender. So I'm maybe running ahead of myself in terms of slides. And then why we like it from an opportunity perspective. So we're about halfway on our transition to net zero. The first half has been much cheaper than the second half, just by virtue of people deciding to do the cheaper projects first. And so there's about 50 to 60 billion remaining of capital that's needed in order to get to our net zero numbers. As I mentioned before, about half of that will be equity and half of that will be debt. So there's an enormous opportunity to finance these projects as they come online. And from a lender perspective, you're not taking any risk on whether they do come online or not. Your capital is only ever used once there's a project and a contract and a builder, all of your permits, and it's only ever drawn usually behind the equity going into these projects in order to make sure that there's alignment with the developer. As I said, sort of debt and equity. And then the other thing that's interesting just to think about when you think about infrastructure debt versus corporate credit, and obviously these little ups and downs are illustrative rather than an exact science, but when you think about what you're doing with an infrastructure asset, you're spending a lot of money up front, and you're earning a return of that capital and a return on that capital through time. So infrastructure assets have very high margins because there's not a lot of operating noise that needs to accompany them. You've spent on something that then generates you a cash flow through time. So the high operating margin means that there's a lot of cash flow to service your debt. And so you really feel really comfortable in a capital structure that this asset continues to spit off money to both pay your interest, but also amortise your outstanding loan balance, a bit like a mortgage, over a much shorter period, over a 3, 5, 7 year period. As opposed to sort of a corporate asset where you might have lower margins and there's periods of time that debt service becomes tight, there's periods of time that there's sort of super serviceability, and these types of projects tend to sweep any of the excess cash as well to sort of be a bit more conservative. And when you think about what does a project look like, the black box at the model at the bottom is sort of the cash flow that needs to go to pay debt. it always should sit beneath the contracted cash flow, so that you always feel like there's a contract there, is guaranteed. As guaranteed revenue coming in from a renewables project. And what you'll see is why we like to be in the debt rather than the equity is the equity is far more back-ended in these projects. And so somebody, not to say that it's not a good place to invest, but that cash flow is coming further in the future. There's far more uncertainty around that, which is why you earn a higher return on it. Whereas we really like the fact that infrastructure debt can play a role in your portfolio today where it's immediately spitting off income for you. The loans just naturally amortise over a short period of time. So you're thinking about how you get liquidity. If there's not a buyer of your position when you want to come into it, well, chances are there's a natural flush over a few years of time in order to get your capital back. And then I might be standing in the way, but correlation, you've got very low to negative correlation with other assets, which is why I think on one of the earlier slides you even saw in it, infrastructure didn't have a negative drawdown across the cycle. Obviously, there are still opportunities where there are capital losses, but what tends to happen if there are any loans that are in default, there is just so much asset backing behind them that the level of risk on impairment on infrastructure debt is very low. And moving it into a portfolio, this is a 60-40 Aussie and global fixed income, so it's not equity and debt. But when you look at how you allocate 10 or 20% infrastructure debt into your portfolio, you're increasing your expected return, you're decreasing your risk, and so we really think that there's a nice natural place for it in a portfolio. Our particular approach, so we have an Australian-focused infrastructure debt fund. We have 15 loans across all states except for Tasmania. It's performing, it's targeting about 3% over cash, and we're sort of performing, very much in line with that. There's a combination of solar, storage assets, so batteries, and onshore wind, and there's a diversification across who are the off-takers, so who's buying your electricity, who owns each of the projects, where they're located. And location's really important because the wind blows in different places, blows at different times to when the sun shines, and the grid connection's so important these days. Sorry, it's all a bit nerdy perhaps for this audience, but you want to make sure that you're in certain locations where you're getting diversification across the portfolio. And so, predominantly renewable energy, but we also see some social infrastructure. When we talk about property, it's effectively social infrastructure as well. So it's not, going by building residential homes, it's potentially social and affordable housing where there's a 10, 20, 25-year contract to government, etc., where it's more akin to an infrastructure project. As I said, so performance over the last 12 months just shy of 3% over. We think on a risk-adjusted basis, that's a really good outcome. With some of the assets that are in the portfolio today, that'll probably start to nudge slightly higher. And when you think about it, we talked about it earlier today, this is very much a take money that's either in term deposits and get slightly higher return, or take it out of your fixed income portfolio and move it into private credit. Just a couple of examples really quickly. So I mentioned it earlier, but we're doing solar across different locations. Something like pre-construction is very exciting for us, where you're earning you're coming into that very late stage, no capital's being drawn until it's all ready to start construction, but you're earning an undrawn fee or a line fee or an upfront on that, which is great to lock in some forward tenor and to lock in some return today. I'd say one of the interesting points is that banks are doing a lot of this, and banks are very good at lining up inside the box and saying, if this meets all of the things that we need, big project, and they need to be very big, $400-500 million, we'll do all of our work and we can lend at a very attractive rate to that. But in terms of how the grid comes together, you can't always build $500 million projects here, there and everywhere. And as the projects start to become mid-market, which has been a theme of today, and as there starts to be a little bit of a capital solution that you need to actually think through, which quite often banks aren't able to spend time problem solving for, you're able to extract an outsized return on those. And as we said, we've also got sort of wind, a combination wind, solar for diversification, and battery storage projects as well. Batteries are really interesting because they play a very important role. There's some grid stability, so every minute or every 5 minutes there's different amounts of energy generation coming out of the mix, and so batteries can sort of touch it up a little bit and take a little bit when there's slightly too much or slightly not enough in the system. You're paid by the energy regulator for providing that service. So that's one place that a battery can work. The other is about energy arbitrage, and so you have periods of time where in the middle of the day when there's too much energy, you'll charge up your battery for free, and then at 7 o'clock at night when everyone's come home and boiling their kettles and cooking their dinner and watching television, that's when you're able to discharge into the market and earn a very high return on the marginal price at that point in time. And then we might just for a couple of minutes talk about equity as well. So that's a lot on infrastructure debt. How do we think about infrastructure equity? Well, it's across the same thematics. But what we're trying to do here is to be able to create a big, broad, diversified portfolio of assets aligned to these thematics. So as I said, again, it's an open-ended fund, monthly apps, quarterly redemptions. We're sort of 50% Australia, 50% rest of the world. More than 30 underlying investments today, so you're getting diversification across the partners that we work with, across the thematics, across the sectors, across the age and stage of each of those assets. The portfolio is $500 million today, so it's big enough to get diversification and be relevant to people. And the way that we've gone about it is we've got a little bit of listed exposure, but predominantly co-investments alongside Macquarie's, Brookfield's, Blackstone's, QICs of the world. I think I've just talked about all of these points. When you sort of bring a portfolio together, so what are you trying to achieve on the infrastructure side? It was kind of neat because this number lined up with somebody's earlier today in terms of target returns, so at least we're all on the same page. But when you're looking at bringing all of that together and having that diversification with liquidity, that's kind of your target return. And what ends up happening is you've got an open-ended product, which means that you're not necessarily just buying, building or fixing and selling assets. You might want to have a slightly longer ownership period, which might amortise some of that return over a bit longer. And the liquidity plays into that again. But what you'll find, if you're able to deliver sort of 10 to 12, 11 to 13 on an infrastructure portfolio, it materially decreases risk and increases return on an overall portfolio. Some of the partners that we talked about earlier, what the portfolio looks like today, some of the stuff we've been up to in the last little while. So, what does infrastructure mean? So Repurpose It is a soils and organics business in Victoria. So they basically take contaminated soil out of construction projects, wash and clean it, and then you can use that soil or rock back into those projects again, rather than having to go and mine new rock and putting that contaminated product into landfill. So it has about 50% market share. It has proprietary technology, and it's competing against landfill, where there's a landfill levy in the market, which means that the government set basically a fine, if you like, or a toll on using landfill for this type of thing, which means that you've kind of got negative pressure on pricing. We've got a build to rent project. Half of that project, so about 250 apartments, are affordable, and so the government pays you a cash flow to rent them below market. So we really think about the risk return on an asset like that. We've got an aged care business, again, government-linked cash flows. Octopus is a renewables developer and also renewable software technology that is being rolled out by all of the big network operators in order to manage renewables onto their systems. We've got a data center platform in the US. This is using 100% renewable energy, and it has a thoughtful way on its water usage as well. So it's sort of closed system water, because some of the resource intensity around data centers is sort of a big question mark into the future. Then we have a venture capital platform that's going into early stage climate-focused investments. And we really like that because it's a few things. It helps inform what we're doing in the other parts of our business, because, well, how are you potentially going to get, taken out of a job with the next big thing, and how is there going to be a risk on some of these long-dated infrastructure projects? But also climate tech's a really important part of getting to net zero, because there's a wedge of net zero, which at the moment is a little bit of hope in terms of how we're going to close that gap. And it's going to come from one of the next big things. We'd like to be investing into that sector, but it's very important that it's a win or lose sector, so you need to have specialists that are on the tools day in, day out, understanding sort of addressable markets and the winners overseas, and who will succeed and who will fail in that space. So I might pause there and see if there's any questions.
just on the credit side of things, I was just really interested in the lending. Is it on a floating rate? Do you do fixed rates? Like, how do you hedge with interest rates going up and down so quickly at the moment?
Yeah.
What you're going to do, and is it the duration? Do you go, okay, the project's 5 years, we're going to do 5 years? Or how do you think about that?
So there's not a perfect answer because it sort of depends on where you are in the cycle. At the moment, the way we go about it is taking a floating rate with a floor. So we're looking at the world today and saying, hey, we'd really like to lock in today's pricing, but what's the implication or how do you go about doing that? So we might say, hey, you've got base rates at a bit over 4 today. We might lock in a floor on that at 3.75 for the 5-year period, which effectively lets us underwrite that at a fixed return for today. Why does our counterparty do that? Well, there might be less options available to them, so that's just what the market is today. Or similarly, it might then be affected in terms of their drawdown through time, and so maybe you might do something funky with your line fee as well in order to sort of help them out a bit while also lock in that return for you.